and the heart of the bustling financial landscape, where fortunes are made and dreams are shattered, the Federal Reserve stands as a sentinel of economic stability. For over a century, the Fed's decisions have reverberated through the intricate web of financial markets, impacting everything from interest rates to investor sentiment. While it does not possess a direct lever to control the stock market, its actions and policies hold the power to sway its course, often tracing a history of intertwined destinies. The inception of the Federal Reserve in 1913 marked a turning point in the financial history of the United States. Born from the aftermath of financial panics and economic instability, its primary mission was to cultivate a robust monetary system that would withstand the tumultuous tides of the market. As a guardian of the economy's pulse, the Fed assumed the roles of the monetary policy architect, the lender of last resort, and the custodian of consumer protection. The early years of the Federal Reserve were characterized by its efforts to establish its credibility and authority. During World War I and its aftermath, the Fed grappled with inflation and interest rate challenges. These experiences solidified its understanding that its policies held sway over not only the economy but also the financial markets. The Fed's first foray into influencing the stock market could be seen during the Great Depression. Struggling under the weight of economic collapse, the nation turned to the Fed for a lifeline. In response, the Fed implemented measures to stabilize the financial sector, inadvertently influencing the stock market's trajectory. It was a testament to the subtle interconnectedness between monetary policy and market sentiment. Yet, it was in the later decades that the Fed's influence on the stock market became more pronounced. The implementation of monetary policy tools, particularly interest rates, emerged as a powerful force. Lowering interest rates fueled borrowing, enabling businesses to invest and consumers to spend. This injection of economic activity often translated into increased corporate profits, enhancing the allure of the stock market. The 1980s and 1990s witnessed the ebb and flow of the stock market as the Fed grappled with inflation control and economic growth. Its deliberate actions to adjust interest rates sent ripples through the market, often leading to market reactions that went beyond conventional economic models. Similarly, during periods of uncertainty, the Fed's liquidity injections and assurances of stability provided a much-needed respite for investors, curbing panic and averting market collapses. The aftermath of the 9/11 attacks and the 2008 financial crisis showcased the Fed's role as a crisis manager. By extending emergency loans and providing much-needed liquidity to financial institutions, the Fed played a pivotal role in shoring up the financial system and preventing a complete meltdown. The turn of the 21st century introduced a new chapter in the Fed's influence saga, quantitative easing. In the aftermath of the global financial crisis, the Fed began purchasing government securities and bonds. This expansion of the money supply aimed to lower long-term interest rates and stimulate economic growth. As bond yields dipped, the allure of stocks as a higher-yield alternative intensified, contributing to stock market upswings. Communication became a powerful tool in the Fed's arsenal. The nuanced dance of its statements and press conferences could sway market sentiment with the mere mention of policy shifts. Investors hung on every word, attempting to decipher the Fed's intentions and predict its next move. An inclination towards accommodative policies could send stocks soaring, while a hint of tightening might lead to caution in the markets. History is replete with examples of the Fed's influence over the stock market, but it's crucial to understand that it doesn't hold a puppeteer's control. The market is a complex ecosystem influenced by an amalgamation of factors. Company earnings, economic indicators, geopolitical events, and technological advancements all contribute to the ebbs and flows of stock prices. As we navigate the ever-evolving financial landscape, the symbiotic relationship between the Federal Reserve and the stock market remains evident. With each monetary policy decision, the Fed sends ripples through the market, shaping investor behavior and charting the course of economic growth. While it doesn't dictate the stock market's fate, it certainly wields the power to leave an indelible mark on its narrative. In this dance of influence, the Federal Reserve plays a leading role, guiding the rhythm of the market's movements and reminding us of the intricate connection between monetary policy and financial prosperity.